Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Artificial intelligence, or AI, it was the big stock story in the first 7 months of the year. But that narrative has started to sputter a little bit as higher rates and perhaps too much hype have dented AI stocks. We need more names, frankly. Let's talk with John Mayer, Chief Investment Officer of Global X, who runs the Global X Artificial Intelligence and Technology ETF and the Robotics and Artificial Intelligence ETF. Todd Sohn is the ETF and technical strategist at Strategas Securities. He joins us as well. John, your two big ETFs were huge outperformers in the first half of the year, but they've sunk in August. So what's the problem? Are we dealing with valuations? Are we dealing with interest rates? Is it China? What's the issue?
Well, certainly performance is really strong. Interest rates are certainly causing the markets to kind of take a second look. But if you actually look at the components in some of these ETFs, and they work really nicely together, BOTS has a large component of industrials. Industrials are companies that can help other companies enhance their efficiency. You look at the CapEx cycle, it's been super strong. Companies are investing in themselves. So if you look at some of the key holdings in BOTS, Intuitive Surgical, Keyence, Dynatrace, those are going to help other companies improve in terms of automation. And I think that's something to really focus on. It's not really about all artificial intelligence. It's a component, certainly.
Yeah, I want to focus on this because buy NVIDIA was the answer to every AI question in the first half of the year. But what I like about BOTS is there are broader potential beneficiaries. So the Robotics and Artificial Intelligence ETF has some suggestions here. I want to just go over them. Intuitive Surgical, and you're right, these are plays on improving efficiency. I think that's a great way to talk about it. Intuitive Surgical, this is a robotic automation, right, for surgery.
Yeah, healthcare surgery, and you know, AI plays into that. The more information, more data points you have will improve the overall surgery, and that will certainly feed into the technology from Intuitive Surgical. You also have other companies that have sensors and barcodes, you know, Dynatrace and Keyence.
Dynatrace is software intelligence in general, right?
Yes.
Keyence is industrial automation, essentially robotics.
Exactly, and Fanuc is another large component, which is industrial robots.
Yeah, makes a lot of sense to me. Todd, you watch ETF flows very carefully. There still seems to be interest in these AI ETFs, but other thematic tech have seen outflows this year as well. So make sense of this for us. There's inflows still in AI ETFs, but other kinds of thematic tech have seen outflows this year.
Right. I think BOTS has been a beneficiary of this, right? They've seen strong inflows as investors realize they need AI exposure, right? I'm sure there are managers whose clients want the exposure to this theme because of its potential. But for the broader market, I think it's very odd and peculiar that tech ETFs have had outflows, right? The XLK, you talk about ARC, the innovation suite has outflows, that the behavior of investors is not in sync with the market, right? The NASDAQ 100 at one point was up 40% this year, yet it's not being embraced like it was back in 2020 or 2021. There's no euphoria this time around.
But this is part of the keys of behavioral economics. People don't buy low and sell high. They actually do the opposite. So last year, ARC had inflows in a terrible year. Yeah. This year, August accepted, ARC's been performing great, and it's had outflows. So how do you, I mean, am I right to look at this as a behavioral economics thing? I mean, why are people souring on ARC when it's had a good year?
Absolutely, I agree with you. I wonder if there are those who were burned, maybe they bought on the way up in 2020 and are now just trying to get out with this rally. Perhaps trying to buy the dip last year, not realizing that we were in a very difficult environment between interest rates and inflation. And now they're saying to themselves, they're throwing in the towel. Let me look elsewhere. Let me maybe perhaps go to AI instead, more strictly exposed based there.
I also think there's a recency bias. I think last year you would think there would be a follow through. Yeah, there'd be a rebound. Once the rebound occurred, then you're getting a little further away from it, starting to realize what's going on in the world, China, interest rates. Then perhaps you're pulling back at potentially the wrong time.
So by recency bias, you mean individuals see what is immediately in front of their face, the most immediate things. And when you start out the year and you're down 20%, you're starting to sell into it, thinking any rise is good. I want to get out.
Yeah, pretty much.
Yeah. Now you have another AI ETF. It's a bit more mainstream. I want you to talk about this. This is the Artificial Intelligence and Technology ETF. AIQ is the symbol, but it's got Amazon, Alphabet, IBM, Cisco, Meta, Adobe, Alibaba, everything's 3% in the biggest.
Yeah.
And there's a reason for that, right?
There is, because there's a cap on the weighting upon the rebalance. So if you think about what drove the market this year, the Magnificent Seven, whether it be in the NASDAQ or the S&P 500, you don't have caps on them. They're market cap weighted. The price of NVIDIA goes up. It's obviously a higher exposure in the portfolio. Upon rebalance in AIQ, while it has many of those same names, you get rebalanced to 3%. So you don't have as high of a concentration in those names. But those names are really important in the AI space because you think about what's driving AI, it's data. Data is super important. These large companies have exposure to data or the hardware components. And that's right now what AI is while we're trying to figure out where AI is going.
And I think this is so important, Todd, that AI really is a play on efficiency. I would say productivity. Right. So all those people, and it's really just another new technology that exists where technology's been improving efficiency and replacing jobs for hundreds of years. We saw this. I always like to joke when I was a college student, I was a telephone operator. And people would call into the building. I want to talk to room 210. I'd take a cord out, put it in, and that went away. That job, that was 50 years ago, that job was automated, out of existence. It was more efficient to do software than to have me standing there plugging in. And this is what's happening now. Back office functions will come down. Software as a service has been doing this for 20 years already. So, for example.
The interesting part of this, and John mentioned it with some of the companies in BOTZ, you're talking about productivity, is the industrials benefit. And I think that's an under-the-radar story. Everyone, not everyone, but most people believe AI is a tech play. Well, industrials as a sector have done very well over the last 10 months or so. And so I think you're starting to see that play out among the securities John mentioned and then other parts of the sector too.
Yeah, there are industrial companies like Eaton and Ingersoll Rand that are now considered sort of plays on improving efficiency. There are anything involved in industrial automation or power generation where you can, more efficiently use products. And Ingersoll Rand and Eaton are part of that, and they've been moving up, outperforming, and I think partly on the perception that they can do better.
You can get overweight industrials pretty easily. It's, 9% of the S&P 500? So if you wanted to skew towards that area, it's much easier to do than 28% of technology.
I still go to the problem of any pure play stuff that exists around this. Are there any private companies out there that AI potential? Can you give me any names?
Yeah, if you think about it, first of all, the AI space has been concentrated in those Magnificent Seven. And so there's a lot of private equity money going into different companies. Now, one company that comes to mind is CoreWeave. That actually buys GPUs and rents out the space. So NVIDIA is selling to many of these large companies like AWS, but AWS is a competitor. CoreWeave, they're looking for smaller companies where they're giving the opportunity to other companies to buy the GPUs, to use the GPUs. I'm talking about NVIDIA.
Is this a cloud business essentially? I mean, is this like a mini AWS?
It's a rental opportunity in a sense for the GPUs. So smaller companies that can't pay $40,000 for, or can't even get a GPU, are renting the space from CoreWeave. The revenues went from $30 million to $600 million in 1 year. Going to be a very profitable business. It's not going to be a standalone just to this company.
Are they thinking of going public or what?
I have no idea. I would imagine so at some point.
It makes sense. Anybody else out there? That's a good one to watch, though.
Within the cloud space, well, it's not necessarily private companies. Freshworks is one of the holdings in cloud computing, which is very important to AI, because if you think about what's needed for AI, the data component is huge. Where do you store that data? In the cloud. So cloud companies can really benefit from the AI revolution, and are.
So GlobalX, I want to move on a little bit here. GlobalX launched some of the very earliest thematic tech ETFs. I remember having you on ETF Edge 5 years ago, 2018 and 19. You did electric vehicles, you did drive, cybersecurity, bug, you did cloud computing, CLOU, and they're all down in August. Again, I guess it's the same question here. Interest rates higher, a little bit of overvaluation, maybe some China issues at all. What do you do? Because a lot of people piled into this stuff, and this is the problem I have with thematics in general. Right. At the top, you pay a lot of money because the interest is high.
Sure.
And it tends to move down over time. And that's the problem with these long range. This is Jack Bogle in me saying, this stuff, Bob, long term, revert to mean. you know?
Yeah, you know, thematics are an area that can move up fast and can move down. So we do say you should take a longer-term investment horizon for thematics, 5 to 10 years. That being said, interest rates certainly impact the cost of capital for these companies, and that could reduce margins. But there are also secular themes that are undeniable. So when you think about cybersecurity, you look at Palo Alto today, where the stock is up a meaningful amount on earnings, revenue misses. Cybersecurity is super important to both cloud and AI. They all have to coexist in this ecosystem. So that's important. So you have to take a longer-term view. Going back to electric vehicles, the electric vehicle adoption is happening. You're seeing the sales of electric vehicles go up every single year. The chart goes like that. Will you get a negative quarter, a negative year? Certainly. But directionally, it's moving in one way.
Yeah, it's an important thing. Todd, any thoughts?
I think thematics can be difficult to get the entry and exit right. But the silver lining is, let's say there's a name you like, whether it's a Tesla or Rivian, but you don't want to get too concentrated. The thematic ETFs allow you to at least spread out that risk among the competitors. And so if the whole space starts to eventually work, then that's also to your benefit as an investor.
Of course, the Jack Bogle would say, why don't you just buy XLK, you know, the whole technology space?
But you may not have the right exposures you want there. You know, that can be dominated by Apple and Microsoft.
Well, but the small stocks might not. Yeah, that's a good point. So we'll just talk 30,000 point of view here. Where is AI heading? What's after hardware? Is it really an infrastructure play? Is it software services? How about AWS? How about Amazon? How is it using AI? How is it being integrated?
Well, I think we're in the early, first of all, AI has been around since the 50s.
Yeah.
What's new is that AI is now available to the public. ChatGPT brought it into our domain to talk about, you know, how are companies going to use it and use the technology for efficiency. And I think that's the real story, is efficiency. It's going to be embedded into almost every business that we think of, whether it be from the law profession to healthcare. Doctors can use it so efficiently to diagnose and prescribe the right medicines. It's going to take that time away and provide that time for patients. There's so many different uses for AI, and I think we're still in the stage of how do you effectively use it? And that's why you've only seen the kind of like these 7 companies.
I'll tell you what I want, and I've been waiting for 10 years, a personal digital assistant. I want Bob.ai. Bob, personal digital assistant. I'm going to Miami. What's the most efficient flight to get down there? I'm going to California. Can I fly into Santa Barbara? Stupid things like that. It's amazing how much time you spent chasing around little things about just managing your life. So I want a personal digital assistant to manage my life. Now, I know the risk is it's going to know more about me than I do eventually.
Eventually, but I think that's happening. If you think about chatbots and how you go on some of these websites and they're so inefficient, and you get frustrated by the answers. Generative AI is going to make that so much more efficient.
They pop up all the time now. How can we help you?
But it's going to be so much more efficient because they're learning from these conversations, learning from your information. Too much information maybe at some point, but we're going to be in a world where it's either AI or not be involved. I mean, it's going to be binary.
Let me just move on here. Todd, one of the more interesting flows to watch this year has been covered call ETFs. Now, these own an index like the S&P 500 or the NASDAQ 100, and they sell calls. So you get a little bit of premium and some downside protection. So these ETFs, you have them, the Global XYLD and QYLD. They're continuing to pull in money. But the funny thing is they tend to underperform in an up market, which is what we've got. So explain this to us, Todd.
They have a dual
Again,
purpose,
this is that behavioral economics problem I see here. Money keeps going in an up market.
I would love to know the demographics of who owns covered call funds, whether it's the Global X, the JP Morgan products, or other ones out there. You're getting the income, right, each month, and the protection against major drawdowns, right? Even though it's a little bit more low vol, you're going to trail in a major bull market. But that fits the profile of, say, an older investor closer to retirement, right? So I think that's the appeal of those funds for a lot of folks out there.
So you think it's not just, they're probably aware that it would underperform in an up, they just want some protection long term. They're buying like an annuity to a certain, to a certain extent. They're buying, it's not really an annuity, but they're buying some protection in some way.
Well, a covered call fund works best in a range-bound market. You're selling your upside. And you're limiting your downside to the extent the premium received from the option premium. Now, some of the QYLD, XYLD yields are in the 12% range. That's very hard to give up, particularly for an older client. But you'd be surprised. There's a lot of younger clients who are actually buying these products. If you look on Reddit and TikTok, there's kind of a cult following for some of these products.
Because the downside protection and they still have a high yield.
The yield is really the story. There's certainly downside risk.
But they do understand yields are not magic money. This is the hard thing I have explaining to people. People somehow think that, oh, I'm getting a 3% dividend yield on my stock. It's like free money, but it's not. It comes at an expense.
Of course not. There's no free lunch.
Yeah.
But it's still hard to give up a 12% distribution rate.
That looks like an amazing number. Like, it looks like free money to a certain extent.
People love income, especially when inflation is where it's at and expenses are going up every day.
Yeah. Let me move on. Global X recently launched 2 actively managed funds to invest in 2 of the world's biggest developing markets. The Global X Brazil Active ETF, the symbol is BRAZ, and the Global X India Active ETF, NDIA. Tell us about these. This is interesting. Again, I'm not a big active guy, but these are 2 big markets.
Sure, India is a huge market. You think about, there's 1.3 billion people in that market. The middle class is moving up. The barriers to have factories in India is easier than some other countries. It's a politically friendly country to the West. So there's a lot of opportunities in India. The actual capital markets are a little more difficult to access, but this is a space where we feel active is certainly a better place.
When you say active, what's active about it? Who's managing this?
We have a portfolio manager who's actually looking at analyzing individual companies within the space.
And you're looking for what? What are the factors here?
We're looking for growth. We're looking for stability. We're looking for increased market share. All the usuals aspects you're looking for in a particular company. So we think because of the demographics of the country, because of the political situation in the country, we think it's a great place to be.
The story makes complete sense. The problem is an efficient market. We all know this, right? But this year, emerging markets have had a tough time.
I love the idea of active EM because the MSCI Emerging Markets Index is so warped right now
by China.
By China. It's become a disaster zone at this point. So I think if you're going to play international, particularly emerging markets, you have to do it actively. That benchmark doesn't work, and investors continue to allocate it still, despite it going nowhere for 15 years, despite the underperformance. And so I think every issuer out there needs to be paying attention to what Global X did and looking at these as an active play at these markets.
Doesn't it? But just to defend indexing, if you're just a China investor itself, the China market long term may actually do fine. It's decoupling now, and that's a major problem for the West. For China investors.
The stat I always like is China over the last 30 years is annualized at less than 1% per year. So you've basically made no money there. It's such a boom and bust vehicle. Now I understand the story, the growth story there, but when you look at it statistically, it just doesn't really add up to the attention it gets.
Yeah. Any thoughts on where we're going for the rest of the year in the emerging market space?
I think selectively in emerging markets makes a lot of sense. China certainly has a lot of headwinds, and so when you decouple from the major indexes, I think that's important.
It's easy to sell India as the outsourcing, for the world here. It's moving from China to India. Vietnam is too small to handle computers. Maybe it can handle sneakers. It can do Nike, but Vietnam can't handle Apple, for example. Only India can handle Apple.
It all goes back to the CapEx story and the reshoring and the friendly shoring story. And India is certainly a beneficiary of that story. So, yes.
Yeah. Well, let's keep an eye on all this, folks, because, again, you have the emerging market issue, you have the strong dollar, and you have the active. That's a lot of factors that can affect your performance. But it's still interesting to follow. That does it for this week's ETF Edge. My thanks to John and Todd. We've asked Todd to stick around and give us his thoughts on ETF trading for the rest of the year coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website, as always, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.